Everyone, and welcome to Friendsgiving 2020, where 24 traders will present top trading strategies in 24 hours. This event is brought to you by TimingResearch and TradeOutLoud. The event is being recorded, just like David mentioned, and all the recordings will be available as soon as they're processed on the TimingResearch website and also on the YouTube channel. David Kospaner and I, Anka Metcalf, will be your host today. And before we begin, let us remind you that all information provided today is for educational purpose only and should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any other instrument of any kind. Trading involves a high level of risk. It may not be suitable for all investors. You could lose money. Before deciding to trade, you should carefully consider your objectives, your level of experience, and your risk appetite. Individual performance depends upon each person's skills, time commitment, and effort. Results may not be typical, and individual results will vary. So you must do your own research and make your own trading decisions. So with us today, we have a fantastic lineup. And who's better than Jake Bernstein to open up this huge event for us today. So Jake, you have the mic. Thank you so much for accepting our invitation. We're really looking forward to your presentation.
Thank you, Anka, and thank you, David, for putting this together. I realize, having done things like this before, that it's a logistics nightmare. So I'm very, very pleased to be here today. I'm speaking to you all today from Santa Cruz, California. A few things about me. Well, first, of course, the disclaimer, which is very important, and I'm sure you've seen it at least 100 times. There it is. So a little bit about me. I've been around for a long time. I've only been trading for 52 years, so maybe I can teach you something. Written a bunch of books. I'm a real trader. I really trade. I'm not theoretical. My work is purely technical. I do not look at fundamentals whatsoever. And you can read the rest of the stuff about me as I speak. So the bottom line is this. There's a lot of free stuff out there today. All kinds of things you can buy, all kinds of things you can get that are free. The good news is we've got computers, we've got speed of execution, we have effectively no commissions, we have effectively much important technical information, computers to process the information. That's all the good news. The bad news is most traders still lose money. The question is, why? We're going to cover some of that today. My presentation is going to be very different than what you're going to see from other people. I'm not trying to sell you anything. We'll talk about that more in a few minutes. But let me begin with this. The story of Dr. X. Practically every day I get an email or a call from someone saying, Jake, will you mentor me? Will you teach me how to trade? I have traded for many years, and I have trained personally hundreds of traders all over the world in exactly how to trade, where to get in, where to get out, and so forth. So Dr. X gets in touch with me and he says, will you teach me how to trade? How much will it cost me? I say, Doctor, it's a 3-month program. I work with you twice a week. I teach you exactly what to do. Everything is completely clear. It's all rule-based. It's $10,000. He says, $10,000, no problem. How long will it take me to become a successful trader? Well, that depends a lot on the individual. So I said, knowing that you're educated, knowing that you're a doctor, which is one mark against you, and I'll explain that later. We will hope that within 3 months, you'll learn the methods. By the end of 6 months, if you're breaking even, I'll be happy. And you should be profitable by the end of the year. He was taken aback. He says, you mean I have to wait that long to be successful? Well, doctor, how long did it take you to become a doctor? You went to medical school for 4 years. You went to residency. You went to internship. That's probably 8 years at least. And guess what? You can get malpractice insurance if you kill somebody. I can't get malpractice insurance. There is no malpractice insurance for trading. So if you're not happy with that information, you need to go somewhere else. The problem in today's market is this. There are millions of Dr. X's. They go to Robinhood, they open an account, they expect immediate results. It's not going to happen. So let's talk a little bit about that. Today and tomorrow, you're going to get free stuff. There's a lot of free stuff available. In most cases, free stuff is worth exactly what you pay for it. Webinar attendance is at a record high. Why? Because people have nothing better to do than sit around at home on their computer looking for things to do. So what do you think you're going to get for free? In most cases, you're going to get aggressive promotion. You're going to get someone who shows you part of their methodology. They're going to say, look what we can do. They're going to show you examples that work. They're going to say, now, if you like what you see, you can buy it from me, and it's only $4,995, discounted from $5,700. Here's what you're going to get. You're going to get this. You're going to get that. You're going to get a live trading room. You're going to get a chat room. You're going to get support. You're going to get this. You're going to get that. You're going to get software. You're going to get books. And if you order now, I'll discount the price to $2,500, but we've only got 25 of these available, so you got to do it right away. And if you do it now, we'll throw in a free potato peeler. So just joking. So what you're going to get from me today is none of that. You're not going to get any aggressive promotion whatsoever. But I want to warn you. Excuse me. You work hard for your money. Be vigilant and cautious. Don't believe anything that you hear from me or anybody else, except unless you've tried it and you see it working. I'm going to teach you 3 very basic things today. They're essential to making money. If you're already making money, it could help you. If you're losing money, it will definitely help you. So here's what we're going to do today. Number 1, consider the plight of the average trader. Somebody's watching TV and somebody says, you need to trade. You have nothing better to do but stay at home. Trade. Open an account at Robinhood. Be like the E-Trade guy who's sitting in front of the screen. The world around him is collapsing. Kids are throwing things. The refrigerator is malfunctioning, but he doesn't care. He's got his headphones on. He's looking at chart pattern on E-Trade. I wish it was that easy. The fact of the matter is, the new trader goes to the internet and says, teach me short-term trading. They get 433 million hits. What are you going to do? Most of the initial hits are all ads offering to sell you stuff. The problem is, most of that stuff does not work, and we'll discuss why. So, many traders lose and they keep losing. Let's ask a couple of questions. Traders have certain behaviors. Behaviors lead to success or failure. We're going to talk a little bit about what winning traders have in common, what losing traders have in common. How do I know that? Easy. First of all, as I've said before, I've mentored personally hundreds of traders. I've spoken at investment conferences all over the world, probably 800 of them in total. I know what makes traders win. I know what makes traders lose. It's really, really simple. Can traders learn to win? Sure they can. But traders also learn how to lose, and we're going to talk a little bit about that. So let's look at some of the column elements. And by the way, as far as information is concerned, before I became a trader, I had another job. I was trained as a clinical psychologist. So I started working on my first job in a mental institution with extremely regressed psychotic patients. Very similar to the work I do now, but I get paid a lot better. So, common elements. In spite of all the advances, things have not changed. What advances are we talking about? As I said before, faster computers, faster order execution, no commissions, better information, and I put better information in quotes because we don't know if it's better information. So traders still lose money, and we want to know why. So let's talk about this a little bit. Based on my observations, these are the reasons that people lose money. First and foremost, They don't start with enough money. People are thinking, I'm just going to take an extra $1,000, put it into the market, and take my chances. If you don't start with enough money, you can't sit through the drawdown, the period of losing trades, and then you're kicked out of the market. Everybody and their brother wants to day trade or scalp the market, politically incorrect term. Guess what? I wrote the 4 best-selling books on day trading for McGraw-Hill. I am telling you, don't day trade. There was a time when day trading was viable. That time is no longer. When you're day trading, you're competing against the biggest, the best, the fastest computers and traders in the world, and they will clean your clock. You will work hard. You might as well get a job at McDonald's working for $14 an hour. It's not going to work. Traders that are new try to use small stop losses. I get these calls all the time. Hey, guess what, Jake? I bought gold. You did? Well, what's your stop? I'm going to risk $500. So you bought a gold futures contract. Your risk is $500. Where did that $500 risk come from? Well, it's all I can afford to lose. Well, if it's all you can afford to lose, do you think the market gives a damn about that? If the market is trading in a range of $800 or $900 a day, or even $1,500 a day, your stop loss is asking for trouble. You will get stopped out. Your stop loss has to do with the strategy, not what you can afford to lose. Many new traders use several different tools or strategies to analyze the markets. They look at a chart. They say, well, the cycle is going up. It's at support. The trend line is up. Momentum is bullish. The seasonals are bullish. I'm going to make the trade. That's called analysis. We don't analyze trades. We use different strategy based on rules. It's a rule-based approach. People like to find trades in chat rooms. If you want to find the biggest losers in the business, go to the chat rooms and see what they're saying. You will find so many losers there, it's unbelievable. Avoid chat rooms. Don't react to the news. In fact, I say don't even listen to the news. Some of the biggest losses people take is when they react to the news. Markets anticipate news. They don't react to them in the same way that you think. People study fundamentals to find short-term trades, like crop reports. Fundamentals are big picture information. They will not affect the market more than briefly during any point in time. Don't study fundamentals. It's not going to help you unless you're an institutional trader and you have to make decisions based on the big picture. Most traders are severely disorganized. They don't know where their orders are. They don't keep a spreadsheet. They don't keep records. It's pathetic. Many losses that are taken unnecessarily are due to disorganization. And this one is really important. Failure to understand order types and their proper application. Do you understand the difference between a stop order and a stop limit order? Do you understand an OCO order? You need to understand orders. It's the biggest part of the game that people make mistakes at. One of the biggest, inability to use or understand profit maximizing strategies. You need to be able to make the big trades. 80% of your money is going to be made on 20% of your trades. If that's the case, how are you going to get those 80%, those 20% big trades? There's a strategy for doing that. People don't understand the meaning of a track record. Somebody says, here's my track record for the last 5 years. We've been right 73% of the time. Wonderful. What about the 25% of the time? What about the drawdown? What about the maximum consecutive losses? We know from the study of human behavior and traders that most traders are unable to take more than 2 losses in a row. Here's what happens. The new trader comes into the market with a strategy and they say, I'm going to make that trade. It looks good to me. They make the trade. They lose money. They're not sad. They're disappointed. They're saying, we understand it's part of the game. I'm going to do it again. I'm going to have discipline. Just like Jake says, have discipline. They make the trade. They lose money. You say, well, wait a minute. This is no fun anymore. I thought it would be easier than this, but I'm disciplined. I'm going to make the next trade. They make the next trade. They lose money again. For the vast majority of traders, and take my word for it, I've seen it, I've lived it, taking 3 consecutive losses is so disappointing, they don't want to trade anymore, or they will look back and they say, if I had only done this a little bit differently, it would have worked. Don't do that. We know factually, and remember, I do fact-backed rules-based trading. We know factually that even the best trading strategies in the world will lose money 6 times in a row. If you can't afford losing 6 times in a row financially or emotionally, this game is not for you, or you have the wrong strategy. Many traders make decisions based on emotions. We know that for a fact. We don't even have to talk about that. Unwillingness to accept losses while they are small. Here is the underlying characteristic of small traders and losing traders. They like to get out of their profits quickly. They like to keep their losses till they grow hair on them. A trade that usually begins the day as a day trade and ends up as a loss becomes an investment. Too many people spend too much time studying the market. Less is more. Lack of consistency. People jump from one thing to another. They try to become an expert at everything. They want to trade options. They want to trade futures. They want to trade option strategies. They want to trade stocks. Not good. You want to be a specialist, not a generalist. And last but not least, common thinking. What do I mean by common thinking? Common thinking is this. Let's buy it and put a stop under the low of the day. Let's buy it if it comes back down to support. Where is support? Well, support is right at this trend line. But the market doesn't come down to that trend line. Well, let's make the line a little bit fatter. Let's make the market fit what we want it to do. Now let's look at the other side of the coin. What are the characteristics and qualities of winning traders? And by the way, let's go back to this list. If you find even 1 or 2 of the things that you're doing on this list, look in the mirror and be honest with yourself, because you're probably not going to make any money ever unless you change this. The good news, there's ways to change it. So let's look at this one. These are the qualities that I have found to be consistent with success. Having and using a completely rule-based fact-backed strategy. I will show you some of those. Having a first profit target to reduce the risk. So people ask me, what do? I say, I'm a risk manager. I manage risk. I have a target on every trade that I make, but that is just my get out of trouble target, get out of danger target. Once I reach that target, I have no significant risk of loss, and I use the rest of the trade to maximize the profit. I want to have sufficient capital to ride out at least 6 consecutive losses. That's very important. You must begin with sufficient money. The most successful traders are usually not day traders. They're usually not interested in news or fundamentals unless they're hedge fund managers where they're going for the very big long-term picture. Winning traders have huge attention to details and procedures because remember what I said, most mistakes are made based on errors. There are 2 kinds of trades there are 2 kinds of losses I distinguish between. The smart loss and the stupid loss. The smart loss, you did everything you were supposed to do. It didn't work. The system didn't work that time. The stupid loss, you didn't do what you were supposed to do and you lost money. You're stupid. Don't do that again. Most winning traders are clinically dispassionate. What do I mean by that? I borrowed that term from my original profession. Clinically dispassionate. You must not be attached emotionally to what you do. One of the best traders I ever met told me this. In order to make money in the markets, you have to not care. It sounds like a contradiction of terms, but the fact of the matter is, the more you care about making money, the more you care about a trade, the more attached you are to that trade, the more likely you are to make an emotional decision. Emotional decisions will not serve you well in the market. Most successful traders are focused on 1 or 2 strategies. They're not all over the place. They're looking at something very specific, and they trade based on that, and they're not looking everywhere for everything. They're knowledgeable in the types of orders. Example, conditional orders are very important. They understand the 80-20 rule, which I talked about before, by which I mean 80% of your money will be made on 20% of your trades. Take a look at your trading. Look in the mirror and be honest with yourself. This is a good time to do it. You've got time. Maybe you're not going into the office. Ask yourself the question, where have you made most of your money trading? If you have made any money trading. If you don't have big winning trades, you're not going to make it. What do I mean? Example. Let's say that your average trade is $500. Unless you have some trades that are $5,000 that you made during the year, you are not going to make any money. Trying to make money by scalping the market and making a few $100 each day is a losing proposition, folks. It's not going to work. Trust me, I know what the hell I'm talking about. So let's go forward. Let's talk about profession and education. No offense intended to anyone. The lowest probability of success. Physicians, engineers, mathematicians, I should say, and scientists of various types. You're probably taken aback saying, this can't be true. These people are so educated. They've got such skill at attention to detail. What about engineers? They should know how market works. They should know statistics. The bottom line is this. These people in these professions, not all of them, but most of them, are very rigid. They have specific things they want to do. They're not open to rules-based trading. They're not open to procedures of this kind. They think they know a lot when in fact they don't. You can't hone down any trade to the final immediate solution using an engineering approach, because trading is all about probability. So be careful if you're in one of these professions. You're probably not making money, and you probably never will unless you change some things. Educational level. The less formal education you have, the better off you are. I find that my best traders, I find that my best traders are people who have the least amount of education. Why? Because they don't like to complicate things. The bottom line is trading is really very simple. The more you complicate it, the less it's going to work for you. What about the highest probability of success? Airline pilots, nurses, retail store owners, bakers, and I should say your basic Uber driver. Why? These people are into procedures. The best traders that I ever trained were airlines pilots. Why? As one of them expressed to me very simply, he said, before you take off in your plane, you check it out. You make sure that everything is working fine. You take off. Once you take off, there's only 3 possibilities. Possibility number 1, safe landing. In other words, you made a profit. Possibility number 2, you crash and you burn. You die. Possibility number 3, you lose a leg because you crashed, but you still live to trade another day. I like the airline pilot analogy because it works for me and it helps me change my perspective and keep a good perspective. Now let's go on to a controversial one. Women are better traders than men. I have found this to be consistently true. I realize that I'm stepping into some pretty difficult territory here nowadays because no matter what you say, someone's going to get pissed off at you for saying something that they don't like. But this is based on my experience. What is it that makes women better traders than men? Women are less emotionally attached to trading. They're logical. They see a problem and they solve the problem. And so therefore, they're different than men. Men like to get rid of problems by shoving them under a rug. Men don't like to take losses. Women say it's part of the game. Why don't men like to take losses? We can invoke the Freudian explanation from Dr. Freud. Dr. Freud said that when a man loses money, it's equivalent to losing a part of his body, a very vital part of his body that he can't be without. To women, it's not that way. So this doesn't mean you're cursed to failure if you're a man or you're in any of the professions above. You can step out of your role if you know how and why. I'm going to show you a few ways to do that. So look, it's always a good idea in life and in trading to base your decisions and behavior on what you know. Let's talk about what we don't know about trading and what we do know about trading. First and foremost, most successful trading strategies are based on patterns. There's thousands of patterns: price, volume, indicators, structure, etc. The bad news, 90% of these patterns don't work. How do we know that? It's easy. We live in a computer age. Take your pattern, put it on the computer, and see if it works. The best patterns are based on breakouts, but most traders don't want to buy on breakouts. They say, why should I buy it now at this high price if I could have bought it 2 weeks ago? I say, well, listen, smartass, if you could have bought it 2 weeks ago, why didn't you do it? Patterns are very simple, very accurate. They're based on rules. The most accurate patterns are based on seasonality. I'm going to show you on seasonality, a little bit about seasonality today. So we're going to look at facts rather than opinions. So today we're going to look at some high odds seasonal trades, and we're going to look at a trading model. Many times people bring me charts like this, or they send me charts like this, and they say, what do you think of my system? I say, what do I think of your system? I don't see a system here. I see a bunch of stuff and I have no idea what it means. So I say to you, if your charts look like this, do yourself a favor and get rid of it. So let's talk about patterns. We have got so many patterns, it's mind-boggling. There are thousands of them. Here are just a few of the patterns that people look at. The good news, there's thousands of them. The bad news is most of them don't work. So you say, how am I going to figure out how my pattern works? I'm going to say, put it on a computer. Well, if you're going to put something on a computer, you have to have the rules. The rules have to be totally clear. If you cannot express the rules, they can't be tested. That's why so many people hide behind strategies that don't work. They say, well, no, you didn't interpret it the right way. Here is what I see. You say, no, here's what I see. You take 10 people, teach them the Elliott wave, put them in different rooms with the same chart, and ask them the question, what do you see? You will get 7 or 8 different answers. That does not work for me. So what does work for me? Really simple. I'm going to give you a precious list of 19 items that took me 15 years when I first started trading to learn this list. If there's anything I can do for you, if there's only one thing you come away with from today's presentation by me, it's this list. If you don't believe me now, you will believe me later. If you've been to my webinars and you've seen this list and you've used it, chances are you've become successful or more successful. Here is what I want to know before I take any trade, no matter where it comes from, no matter what the theory. My system needs to tell me what stock or commodity to buy or sell. I need to know specifically. I need to know the exact time or price within a minute or less to do that trade. Buy it at this price, sell it at this price. I need that information. I need to know my odds of success. How often has this pattern worked? My average profit, my average loss over the course of many years. My stop loss, my risk, my first target, my profit to loss ratio. I'm going to show you a trade shortly that has had a profit to loss ratio of 17 to 1 for many years, with accuracy approaching 80%. The profit to loss ratio tells you the answer to the question, are you making more money when you're winning than you're losing when you're losing? Very important. Complete track record, average profit in points or percent, largest profit, largest loss, the maximum drawdown, the maximum upswing, all of these easily defined. The number of consecutive losses, the number of consecutive profits, the accuracy of the strategy, how to minimize your potential loss, how to maximize your potential profit, when to move to risk zero, etc. So the good news is this. This type of information is available. But once you get it, you need to use it. If you're not going to use it, you're going to be toast. Let me give you some examples. Let's do this. If I took every futures contract of the June S&P from 1983 to 2019, and I made one chart that represents the typical behavior of the S&P, this is what chart would look like. At the bottom of the screen, I have numbers. These numbers tell me the percentage of time this market, June futures in S&P, has gone up or down during this week. The line plot tells me the direction of the market. I can take this one step further and look at the Dow Jones. So let's look at this chart. Here's a chart showing the Dow Jones seasonal pattern from 1920 to 2019. So folks, we're talking about almost 100 years. During the course of the next few days, if you get track records even close to this, I would be surprised. What does the chart tell me? It tells me that these 3 weeks of April have been very bullish, accurately bullish. These 2 weeks in July, and now November and December, the most bullish time of the entire year, with percentage odds and arrows up indicating high probability of success statistically. What can I do with this information? I can go to the computer and I can say, show me what happens in April in greater detail. I do a search, and here's what I find. Since 1950, in the Dow Jones, buying at the close of trading April 7th, getting out on the close of trading April 16th, with 9% risk, has been right 75% of the time, and it shows me all the relevant statistics. Average profit, average loss, max consecutive wins, max consecutive losses, and I can see the entire history. Very important piece of information. The question is, does it answer everything on my two lists? In other words, these lists that I gave you. The answer is yes. It's completely objective and completely clear. So let me take this one step further with you. And remember, I'm showing you something by example in order to illustrate my points. So let's go to here. Here is the April seasonal trade this year. In other words, when we ran this data over here, we only had data through 2019. Looking at 2020, this was the entry date, this was the exit date. So did it work? Yes, it did work, no problem. Is it going to work in 2021? We'll find out, most likely, however it will. Let's look at another one. An individual stock, 3M. What do I see here? I see something that captures my interest very significantly right over here. Beginning in mid-October, all through November and into the end of December, I see a strong trend up with probabilities of success very high. I can go to the computer and I can do a search. I can find out the exact dates for this trade. This was a trade last year, and there was another trade as well. How do we get this information? We get this information by using fact-backed, rules-based trading. So we don't analyze markets. We use information that's based on historical precedent. Let me show you what I mean. I use the trading model. Let's talk about the trading model. Up until now, today, we've been talking about patterns. Patterns constitute what I call a setup. I know that certain things happen at certain times of the year. It's a repetitive pattern. It's been going on for hundreds, if not thousands of years. That pattern for me is what I call a setup. It tells me that something is likely to happen. And I'm going to show you a beautiful setup that's triggered and is happening right now. I need setups. I find setups by testing them on the computer. The next step in my process is a trigger. No matter how good a pattern has been in the past, it's not going to be good this year unless it triggers, by which I mean Another indicator that says, yes, this pattern will likely work this year. The third step in my process is follow through. There are 3 aspects to follow through. And by the way, ladies and gentlemen, if you're not already doing this, I strongly suggest you change all of your trading to this process. It will make a big difference in your results, a big difference in your profits, and therefore a big difference in your life. The third step is follow through. We've got a setup, we've got a trigger, we need follow through. I'm going to show you all 3 of these shortly. Follow through consists of 3 parts. Part number 1, where are you going to be wrong? You need to know that before you get in. And that is a function of your strategy, not a function of what you can afford to lose. Part number 2, where are you going to be right? What's your first target? Where do you get out of danger? Part number 3, how do you maximize the profit once you've been right? So remember, the profit target is an objective number that comes from your strategy. If your strategy doesn't tell you that, you've got nothing. You've got less than nothing. So let me show you something. People are always talking about the 50-day and the 200-day moving average. People say, well, the 50 is above the 200, it must be bullish. Oh, the 50 just dropped below the 200, it's the death cross. The problem is this, the track record doesn't hold up. I take this idea, put it on the computer, and here's the track record. It's been right 48% of the time. It's made money, but before it's made money, it's had a bunch of money drawdown, so you probably would have been knocked out of the game. It's a very pathetic track record. If you're happy being right 48% of the time, this one's for you. So people say, show more history. Okay, here's more history. 91 instances, 41% accuracy, and guess what? 6 consecutive losing trades. I guarantee you that by the time you've taken 6 losing trades, you're either out of money, out of patience, or you're trading a completely different strategy. That's what traders do. Let's compare. One of the best books ever written on the stock market was written by a man named Art Merrill, Merrill. It's called The Behavior of Prices on Wall Street. Merrill did something very cool. He studied the behavior of the Dow Jones Industrial Average prior to every major holiday in the United States. New Year's, Christmas, Easter, Good Friday, Veterans Day, 4th of July, Thanksgiving, blah, blah, blah. And he discovered something very cool. He discovered that on the day before a major US holiday, the market, based on the Dow Jones, closes higher. Example, this week, Thursday, is Thanksgiving. We don't care about the fact that there's COVID. We don't care about the fact that people are being told not to travel for Thanksgiving, blah, blah, blah. The bottom line is this. The market is closed on Thursday. It's open on Wednesday. It's open on Tuesday. The rule that Merrill found was this. Buy on the close of trading Tuesday, get out on the close of trading Wednesday. Probability of success, over 73% since the late 1800s. This could be a fluke, occur by chance only once in 10,000 times. So a number of months ago, as I do every year, I started showing this trade and asking the question, is it possible that this begins before Thanksgiving? Is there a spread of effect? Does it begin sooner? So I went to the computer using a totally objective methodology and asked the computer, do a search. Begin your search at the beginning of November and end your search at the beginning of December. Search this entire period of time and let me know, have there been any trades with high accuracy during this period of time that support the Merrill work? The answer is absolutely. Check it out. Buying S&P futures, end of day, November 20th. Getting out, end of day, December the 4th. Risking 3% has been right 81% of the time with a profit to loss ratio of 17 to 1. meaning that in sum total, the winning trades have been higher than the losing trades by 17-fold. So what else does this tell us? I want you to think back to the list that I gave you. This tells me everything on my list. The stop, the target. What's the target? The target is the average profit per trade. In points, 19 points. Remember that number. It tells me everything I need to know with complete objectivity. So you might say, well, wait a minute. This year it's going to be different. Why? Because Trump's an idiot, because he's contesting the election, because we have COVID, because we've got troubles all over the world, we've got food insecurity, we've got social distancing, we've got masks, we've got people staying at home. It's not going to work. I say it's no different than ever. If you know the risk and you don't like the risk of 19 S&P points, no problem. You can buy a call option and define your risk. You can do a spread. You can do the SPY spider. I show this trade every year because I want to prove to you that it doesn't matter how many people know something. What matters is procedure and process. This is the track record. I challenge you on any methodology that you're going to see here in the next couple of days to find a track record this complete. Most people don't want to show you this, but they will be happy to sell you a $4,900 system discounted to $2,500 if you're among the first 25 people to respond. So here's the track record every single year through 2019, and here is the results. The cumulative performance, the year-by-year performance, and so forth. And people will say again, well, wait a minute. It's doing too well. The last time it did this well was over here, and then it's had this drawdown. Don't do that. You know the numbers. 81% is a very impressive number. So what happened? This is what happened last year. The entry date, right over here. The exit date, right over here. What happened this year? This is a chart that was just made before I did the presentation today. It entered on the close of trading Friday. This is where we were this morning. It has made its average profit per trade. What's the average profit per trade? Let's go back and take a look. Right over here, 19.83 S&P points. Very simple, very straightforward. So let's go forward and talk a little bit about this. One moment, please. You want another trade? Here is the pre-Christmas trade. Buying, close of trading December 22nd, getting out January 7th, risking 4%, average profit 23 points. And again, I want to come back to the beginning and stress a couple of things to you. Number one, we knew everything on that list that I gave you ahead of time, with one exception. We didn't know if it was going to work this year. We're all grown-ups in this room. We know it's not perfect. We know we don't have perfection. But we also know there's a way to mitigate the potential loss. So as I said before, if risking 4% on S&P is too much for you, no problem. Mitigate that risk with an option strategy and so forth. But by all means, consider the statistics. Let's go forward for just a minute. Here is the December trade last year. So this one's coming up. Let's talk about psychology. What's going to keep you out of trades? Number one, not having sufficient capital to ride the loss. Number two, fear or greed. Number three, interpretation, a dirty word. Don't interpret anything. I want you to think about this. Let's go back in time to last year. We knew that this was the date to make that trade I just showed you, that Thanksgiving trade. If you're thinking, you're looking at this chart and you're saying, well, wait a minute, why should I buy it here if I could have bought it over here? Or you're thinking, it's the beginning of a downtrend, it's the beginning of a correction. Over here, you're thinking, well, this is the Christmas trade. Maybe it's gone too far. Look at all of this beautiful move up over here. I didn't get any of that. I feel bad about it. Don't feel bad about it. Do something about it. There are different strategies that will capture moves like this. The seasonal strategy is not the only one. Let's go forward. Fact-backed rules-based trading. Just a minute. Let me get back to what I was talking about. I want to go all the way back to this list right over here. Just one moment. Oh, yeah, right over here. So this information came from one of my websites, seasonaltrader.com. Not important. What's important is this. When we go to the computer and we ask the computer, show me everything that goes on during this period of time, did I miss something? Can you guys still hear me?
Yeah, sounds good, Jake. Yeah, we can still hear you.
Okay, the reason I ask is because all of a sudden a picture popped up on the right-hand side of my screen. Okay, so look, when we ask for possibilities, the computer gives us all these possibilities. We have a choice. We can choose the one with less risk. If we choose the one with less risk, we get less accuracy. We can choose the one with the greatest profit potential. If we choose the one with the greatest profit potential, sometimes we have more consecutive losing trades. So the choice is yours, but the most important thing is the statistics are there. So let me review for you a couple of things. Let's go back a little bit to this model. Setup, trigger, and follow through is the most important thing I can tell you. It took me 15 years to learn this, but once I learned it, I have never unlearned it. Example, many people like key reversals. Key reversal is the day where you trade below the low of the previous day, above the high of the previous day, and you close higher on the day. If you take that concept, key reversal, which is completely algorithmic, you can define it with a formula, put it on the computer and ask the question, does it have the ability to predict? The answer is no. But if we add a couple of other factors to that pattern, we get a valid setup. It has the ability to predict. But just because something has the ability to predict doesn't mean that it's going to work this year. I need a trigger. What do I mean by a trigger? The trigger is, for example, the momentum indicator. Let me show you what I mean. And by the way, the momentum is one of the best indicators that you can ever use. So let's do this. One moment, please. Okay, here we go. On this chart, I have the basic price right over here. And by the way, I don't use candlesticks. I find them too confusing. But in addition to that, I have two other lines here. The setup was to buy over here. The trigger was to look at these two lines. What are these two lines? These two lines are two moving averages. The red line is an 8-day moving average of the close. The blue line is an 8-day moving average of the open. If these relationships are very clear, by which I mean the 8 close moving average is above the 8 open moving average, it confirms the trigger for the seasonal trade. So you can see I'm using two levels of information. The pattern, let's go back to the algorithm, to the structure. One moment, please. Let me find it. Bear with me, folks. We're almost there. The pattern, which we discovered is the seasonal. The trigger, which is the relationship between the 8-period moving average of the close and the 8-period moving average of the open. And the follow-through, the first profit target. We hit our first profit target almost immediately after the opening last night. So now we are out of danger. Being out of danger means we have no effective risk, and we can maximize the profit by using a profit maximizing strategy, all of which is rules-based. So let me review for you what we do. Setup is a pattern. Trigger is a timing indicator. Follow-through is a method of managing money and managing risk. My goal minimize risk as soon as possible. So now if I can get your help, Anka and David, I will be glad to take questions, if there are any. Can someone relay questions to me? Anybody there? Can anybody hear me?
I can hear you, Jake, but it's pretty
Hey,
quiet.
sorry, Jake, you still there?
Yeah,
I had to set my headset down for just a second.
no problem. So if you can relay questions to me, I'd be happy to answer them.
Oh. Um, yeah, someone asked, momentum indicator is the standard?
The standard momentum indicator, and it's a 28-day momentum.
Oh, okay. Yeah, that was the next question, 28 days. Let's see. This was from earlier in the presentation. Someone asked, how do you prepare yourself if you were in the lowest probability category?
Well, one thing you want to do is make sure you find a strategy that's effective. Make sure you find a strategy that's within your risk tolerance and that's rule-based. I like to talk about what I call the 10-trade challenge. In other words, find a strategy, make sure that it's completely clear, and then take the next 10 trades, if you have the money, strictly according to the rules. Once you do that, you will determine if there's any weaknesses in your approach, if everything is clear, if there's anything confusing in what you're doing, and you will learn a whole lot. Most people are unable to make 10 consecutive trades strictly by the rules, and that's a very, very sad situation. More questions?
Do you recommend doing that as paper trading or actual live money?
Paper trading is like living with someone before you get married to them. You don't find out the bad stuff until afterwards. So I'm not a fan of paper trading.
Okay.
You need to get there in the trenches and have it be real. Otherwise, you're just not going to feel the loss, or you're not going to enjoy the profit.
How much money do you recommend having in the trading account to get started?
If you want to give yourself a good opportunity to be successful in stocks, please at least $10,000. In futures, 15,000. But here's the most important thing: become a specialist. In other words, don't try and do everything. Specialize in what you do. Learn one or two things really well and do them consistently. Any more questions?
Do you ever use the site financial.com for seasonality search?
I do not. I use seasonaltrader.com, which is one of my websites. You can try it for free. It's very easy to use. There's a lot of seasonal websites. Here's the issue. You want to go back as far as you can. Many seasonal websites will show you seasonals that last 10 years. They'll say, over the last 10 years, this has happened. 10 years is insufficient. 20 years is insufficient. Most of our seasonals go back 40 to 50 years, and in some cases over 100 years. The more data you can get, the more statistically reliable it's going to be. Any other questions?
Are there any tools which you can use to test your strategies?
Most of the trading platforms like Trade Navigator, TradeStation have system testing strategies. So you can program in your indicators, you can backtest, you can get all the results that we get. So for example, this right over here, let me go full screen, 1 second, please. This is a track record generated by the Trade Navigator software. It shows us everything that has happened, consecutive losses, consecutive profits, days in trade, everything we need to know. And of course, the most important thing, accuracy of 41.8%. It's possible to make money with 50% accuracy, but the more accurate you get, the better it's going to be for you emotionally and from the standpoint of drawdown. Okay, any other questions?
Do you have a single recommended trading style?
My trading style. Well, I'm going to assume that means trading strategy. The best trading strategy I've found is seasonal. It's the most accurate. It requires the least amount of work. You get the best results. It's got the most statistical significance of anything that I've done. The second one is divergence. Divergence is very difficult to understand, but once you understand it, and once you realize that it's completely objective, you can make a lot of money with it. The third thing that I use is cyclical behavior for long-term trades. In other words, stock market cycles and cycles in futures.
Okay. And one last question: should I concentrate only on one market?
No. Try and diversify in several markets or several different industry groups so that you have proper management of your risk. In other words, it will flatten your equity curve. You won't have extreme highs or lows. And one thing you don't want to do is don't duplicate. So I heard the other day, I heard from a man who said he's long soybeans, soybean oil, soybean meal, corn, and wheat. What do I think? I think he's going to be a hero if he's going to be right. But if he's going to be wrong, he's going to be a villain. And we don't want any of that. So you want to smooth out the equity. Let me just say a couple of more things. People have talked a lot about trader psychology. The first book I wrote for McGraw, for John Wiley and Sons, The Investor's Quotient, was about psychology. Because I thought at one time in my earlier life that it was all about psychology. If you got good psychology and you control your behavior and your discipline, you'll make money. That is not the case. People say you need discipline. They say, Joe, no wonder you can't make money. You don't have any goddamn discipline. Well, where's Joe going to get discipline? It's not going to fall out of a book. He's not going to get it from laying on a psychiatrist's couch and talking about his potty training when he was a baby. It's not going to happen that way. Discipline comes from confidence. If you have confidence in what you're doing, you will have discipline, which begs the question, where do you get confidence? You get confidence from a strategy that works. Where do you get a strategy that works? We've got computers. Find one. They're all over the place. Get rid of the trash and keep the cash. Get rid of the bad ones and keep the good ones. Once you have that good trading strategy, you'll have confidence. Confidence will give you discipline. Discipline will give you profits. Profits will give you more confidence. More confidence will give you more discipline, and that's how it goes. So don't focus on getting discipline. Look, if you have a losing trading strategy and you're disciplined about it, you need to see a shrink. A good trading strategy is most important. If you don't have one, you're going to lose money. You can't have discipline if you're losing money. So that's a very important factor. People say, Jake, which one of your books should I read? And I say, don't read any of them. Things are changing rapidly. Get with it. Get a computer. Learn how to trade. Follow the rules. That's the most important thing. And that's where your success is going to come from. And most of all, avoid tricky people online. There's a lot of them. Be very careful what you spend your money on. Any other questions?
All right, I think that's all we have time for. So thank you, Jake.
You guys are rid of me. You're doing a great job. Thank you very much for letting me be here.
Yeah, great opening presentation. So